In this lesson, how to trade the head and shoulders pattern, the learning objectives are you should understand how the head and shoulders pattern form, and you should know how to properly enter a trade using the head and shoulders pattern. The head and shoulders pattern is a universal pattern that can appear on any market and is suitable for all types of trading styles because the pattern can appear on any time frame. It is a reversal pattern that can be found either at the end of a bullish trend or at the end of a bearish trend, in which case it's called an inverse head and shoulders pattern. Like all reversal patterns, this pattern is a failure of the market to move in a particular direction. The constant failed attempts of a pair to move in the direction of the prevailing trend leads the market to reverse. You can break down the head and shoulders pattern into 5 pieces. First, a strong bullish trend prior to identifying the head and shoulders pattern, or a strong bearish trend prior to identifying the inverse head and shoulders pattern. As a general rule, the longer the uptrend or downtrend lasts, the stronger the reversal is likely to be. Number 2, the price develops a swing high point and has the first retracement. This forms the left shoulder. By swing high, I mean what the swing high, I'll be referring to this often, so I want to say this right now. The swing high is just the high from the previous movement. Like, it's not the highest ever price, but it's the highest price maybe in the past couple of hours if you're looking at 15 minutes, or past week if you're looking at the daily chart. Carrying on. Number 3, after the retracement, the price makes a new swing high point higher than the initial point and subsequently declines again. This forms the head, which is here. Number 4, the price rises for the third time, but only to the level of the first swing high point, before declining again. This forms the right shoulder. The right shoulder is where things come together. It's an indication that buyers are tiring and the market may be getting ready for a reversal. As soon as the right shoulder begins, we have enough to start plotting the neckline. The lows after each peak can be connected to form a support. That's an awful drawing, but you get the idea. Both shoulders and the head of the pattern are needed before the neckline is valid. This level will become a key component when trading the breakout. The slope of the neckline can either be up or down. Typically, when the slope is down, it produces a more reliable signal for the head and shoulders pattern. If you're trading an inverse head and shoulders pattern, you would want the neckline to be going up. In summary, the head and shoulders pattern includes 3 consecutive peaks, with the middle peak, the head, being the highest, and the 2 other peaks being lower and approximately equal. I just want to reiterate a very common point. You need to be very flexible in interpreting the head and shoulders pattern. And the same goes with inverted head and shoulders patterns. There are different ways to enter a head and shoulder pattern trade. The first one, which I would not recommend to a beginner, is the aggressive entry. This involves entering when the right shoulder is developing. Symmetry of the left shoulder is important, and so you would enter a sell position once the left shoulder price is hit. So while it's going up, not even letting it come back down. So as soon as it hits the price, you would enter a sell. But a more conservative entry, which I would recommend, will rely on you waiting until there's confirmation. And you can do this by waiting for a neckline breakout. It's similar to the double top and double bottom patterns, which means that you should wait for a close below it. Because by doing this, you mitigate the risk of having the market snap back on your position and stopping you out for a loss, which is a common mistake among forex traders, because they often assume that the pattern is complete once the right shoulder forms. I would say you can utilize pending orders for breakouts of the neckline, because you could just place a sell stop right here. We covered this in a lesson a while back, so you could use knowledge of pending orders like sell stops, sell limits, etc. to get the best possible entry in a trade. But I would not recommend you to do this without proper knowledge of what you're doing, because you would leave yourself exposed for the possibility of a false break where the price dips below it, triggering your price, meaning that you now have a sell position, and then rising back up, meaning that you're going to lose money. And just like the double top and double bottom patterns, you could wait for a pullback, because it would further increase the reliability of the signal and mean that you have a greater likelihood of making money. Just as there's different ways to enter a trade, there's different ways to exit a trade or place a stop loss. The basic stop loss involves placing your stop loss above the head, so placing it here. This is because if you place a stop loss here and you enter the trade at the neckline or for the right shoulder, for the price to hit your stop loss, the price would instantly invalidate what you saw, so it would be the best decision to do so. To exit the trade here. Although it would mean that you lose money, it limits your loss. However, if you enter here at the neckline, letting the price hit your stop loss can cost you a lot of money, because that is a very wide stop loss, and I do not recommend it. So what I would recommend is you go for a conservative stop loss, entering the trade at the neckline and placing your stop loss above the right shoulder, because it allows enough space for the price to fluctuate, but also will mean that if price does hit the neckline and then goes back up, it would invalidate what you saw. A very aggressive stop loss, if you're very risk averse and you don't want to lose much money, is after you've confirmed that there's a close below the neckline and that price should start dropping, you place your stop loss above the neckline, as this will limit the gap to very little, reducing your risk but allowing you to reap the full reward if you are correct in the trade. I'd recommend that you practice with different types of stop loss and see what suits you best. Now we look at the take profit. Knowing when to take profit can mean the difference between a winning trade and a losing one. It's arguably the most challenging aspect of trading. You could place a conservative take profit at the first key support level, because these areas often cause the price to bounce. So it is good to take profit on a retest of one of these areas. Every situation is different, so these support levels will vary in distance from your entry and the likelihood for the support level to hold. Usually, they would be quite close to the breakout. Maybe you'd get like 20 to 30 pips on average. That's what I would say. Whereas if you went for an aggressive take profit, you could do a similar thing to what we do with a double top and double bottom by measuring the size, the perpendicular side length from the neckline to the top of the head, and then taking this length and measuring from the neckline down to see your profit target. This would be a lot more than the conservative approach. However, it could be too much, meaning price could bounce off a support level in between and return maybe to a stop loss, or the market might change direction.